2, and you can see here this is called Basic Cost Management Concepts. Some of the objectives for Chapter 2, we'll talk about information systems, we'll talk about the cost assignment process, defining what a tangible versus intangible product is, look at income statements for a manufacturing versus a service company, and talk about differences between traditional and contemporary cost management systems. They've changed quite a bit from what they used to be. So the first part of the chapter deals with systems, basically more of the technology side of it. And they talk about accounting information systems. Basically, just think of a system as interrelated parts to perform one or more processes to accomplish an objective. You can see what those are here coming up. And so for accounting information systems we're trying to gather information and process it and then provide it to people who need that information to make decisions. So it's all about collecting data, summarizing it, and reporting it. So it says that we collect, classify, summarize, analyze, and manage data. Then we give it to the people who need to use it. Inputs are usually what they say economic events. I use the word transactions quite a bit, just anything that affects the financial position of the company. So just think of any business and think about what the day-to-day business of that company would be. So if you just think of a grocery store and you think, okay, there's people coming into the store buying products continuously. The store is receiving deliveries from vendors continuously. Employees are working there that need to be paid. The lights are on that needs to be paid for. There's a mortgage or a lease on the building, advertising, insurance, tax. So all those things are more or less economic or transactional type events that need to be measured. The operational model is critically involved with the user of information, and so basically the operations are driving information. And there's subsystems to that, which is the financial accounting side and also the cost management side. Both of those play a large role in, of course, the gathering of data and how it's summarized. And so I know it's kind of small to see there, but this same information is also in your book. So basically you've got your inputs and your outputs. So your inputs are the economic events that happen, the things I just got done talking about. Then you have your processes, the collecting, analyzing, summarizing, managing. And you have your outputs. Okay, so your outputs would be all kinds of different reports. Special reports that can be run ad hoc or as needed. Your financial statements, which have a very prescribed format, they need to look a certain way. Most companies do budgeting, so you've got your budgeting system that's a part of that. Performance reports, basically how do we perform versus our budget? What is there a difference between the two? And then personal communication, and then of course those outputs are given to users who then make decisions, and it goes back to inputs. And so financial accounting systems are really concerned with producing outputs for external users. So your inputs are those economic events, those transactions that happened. The processes, so that data is processed based on certain rules. The SEC, the Securities and Exchange Commission, the FASB, and the IASB, which is International Accounting Standards Board. But just know that there are prescribed rules in place that says accounting has to happen a certain way, and then there's a prescribed financial statement that says the financial statements need to look a certain way. So it's very prescribed for us. We really don't have a choice with how this information is processed or what it's going to look like, because it needs to be given to those external users who want to see it a certain way so they can compare my company to somebody else's and know that the numbers were processed according to the same methods. So for cost management, though, it's a little bit different. So now we're primarily concerned with outputs for internal users and using inputs and processes needed to satisfy management's objectives. Basically, management needs to be continuous in making decisions about how to run the business. And so we need to design reports to give management the information that they need. We're not bound by rules from the SEC or the FASB or anybody else. We can slice and dice the crunch the numbers the way we want to, because this number is just staying internal. We're not giving it to outside third parties. It's just internally generated to help us make decisions. Okay. We talked about the three broad categories in Chapter 1, which were cost, services, products, and other objects. What's it cost us to deliver or make a product or deliver a service? The planning and control function, which is basically looking at the future, and then decision making. Having different alternatives presented to management to help them make decisions. The value chain, if you can recall from Chapter 1, basically is all the activities that we go through to produce, design, develop, market, deliver, and satisfy sales post-service. So basically what it takes to manufacture goods or deliver services to our customers. So many steps on the value chain: design a product or service, develop it, produce it, market it, deliver it, and then with any follow-up service that has to happen after the sale. So obviously there needs to be information around each of those steps of the value chain. So when it comes to accounting systems, it says relationships to other operational systems and functions. So what you want is integration with your cost management system with other systems within your company, so that you always have the best information. You've got information that is coming from other departments that affect your cost accounting, and kind of just turning it into one system. They say integrative, cross-functional, coordinate information to facilitate timely and accurate reporting and decision making. So it's not just accounting information we're using information from multiple systems, integrating that into one report or reports using one system that management can rely on. So cost accounting information systems, basically what we're trying to do is assign cost to products and services and other cost objects of interest to managers. So every time we manufacture a product, every time we deliver a service to our customer, whatever our company is doing, there's a cost associated with that. And if we know what that cost is, we can more efficiently manage our business. And that's a lot of what cost accounting will do for us. Operational control information systems are continuously providing accurate and timely feedback concerning the performance of managers and others relative to the planning control activities. So some of that could be we budget for so many machine hours to produce a product. We should be getting reports continuously telling us, are we within the objectives of the number of machine hours that we believe it should take to manufacture a product? Are we going above that? And if so, why? Or are we under that? And if so, why? So we always are continuously trying to set objectives and then measure the actual to the objective to determine, are we doing this correctly or not? So just accounting information systems as a whole have some subsets. Of course, the big two categories are financial accounting and cost accounting. We're focusing on cost accounting in this class, so we're going to take cost accounting and drill that down to two further subsets, which is cost accounting information and operational controls. So here it talks about cost assignment, direct tracing, driver tracing, allocation, and so a cost is basically something given up, cash or the equivalent of cash, something of value sacrificed for goods and services that are expected to bring a current or future benefit. So basically a company buying things that it needs to produce future goods or services. An expense is an expired cost deducted from revenue. A loss is a cost that expired without producing any revenue benefit. And assets are unexpired costs and appear on the balance sheet. So another word for an asset is an economic resource, something that a business acquires to help it earn revenue and benefit the business in the future. Now, not all assets turn into revenue, and that's what they mean by loss. So revenue is generally what we receive from selling goods and services to our customers. We subtract expenses from revenue. A cost object is something that we can measure, to which we assign a cost. A cost object can be almost anything. And we're going to talk a lot about allocating cost to cost objects. So it could be a product that we produce. If we produce a number of products, how do we allocate some common cost to products? It could be customers. There's a cost to having a customer. It could be costs that departments incur. A cost of a project or an activity is a bazillion ways to allocate and slice and dice costs and allocate them to different cost objects. It's really what the company wants to do and what they want to accomplish. With costs, some costs are traceable. By traceable, we mean that we can say this cost object incurred this cost. There's a direct correlation. When we manufacture this good, we know that this one cost will 100% be incurred and be assigned to that good. That's called direct traceability. So methods of tracing, process of identifying and assigning cost to an object that are specifically or physically associated with the cost object. Okay, this cost happens. We know that this cost can directly be attributable to it. Driver tracing is use of drivers to assign cost to cost objects. And so a driver can be a change in resource usage, activity usage, cost, and revenue. So we'll get into more detail. It's kind of abstract right now, but we'll get into more detail with it. And of course you have indirect costs. And it says indirect costs cannot be traced to cost objects. Assignment of indirect costs is called allocation. And so just kind of to paint a picture, whatever room you're in listening to this, just imagine that room as a factory. Okay, so just imagine that room really is represented by a building that's a factory. And in that factory, you're building desks. And you can probably relate to a desk because there's a good chance the computer you're using to listen to this may be on a desk. Okay, so imagine that desk is mostly made of wood, right? And so wood would definitely be the main ingredient to make it. There's going to be some glue, some nails, some hinges, some knobs, some other things too. Okay, and then also just think about the building that you're in, and think about what kind of different jobs will people be doing to manufacture those desks. Well, you'll certainly have some people who are involved in taking lumber, cutting it, sanding it, assembling it, staining it, attaching the hardware, gluing it together, nailing it together, screwing it together. And they're obviously directly involved in producing the desks, right? Well, you're going to have some other people there too. You're going to have some kind of supervisor, somebody whose job is to oversee the production people, make sure they're doing their jobs properly, scheduling people, handling issues that might come up with quality, with a manufacturing problem, with a slowdown in the process, just supervising in general. You're going to be using machinery. That machinery needs to be maintained. Occasionally it's going to break down. So you have some machinists on staff who are continuously doing maintenance on the machines, making sure that they are working properly. And if something breaks down, they're there to fix it right away to make sure our manufacturing doesn't get slowed down. When a shift is over and you've got sawdust and scraps of wood laying all over the place, there's probably a good chance you have some kind of a custodian type person come in, sweep up the floor, make sure everything's clean so that when the next shift comes along the next day, they've got a clean floor to start from. So some of those people I described was basically one category is directly producing goods. Everybody else, like a supervisor, a janitor, or a machinist, are supporting them, right? So that support crew is indirect cost, right? Because you cannot take any of their cost and directly assign it to one specific desk that was manufactured, because they're there supporting all the desks that have been manufactured. So they're more indirect. So indirect costs cannot be traced to cost objects. An assignment of those indirect costs is called an allocation. Same thing with our factory, right? We've got this factory that we have purchased, or we're leasing it, or we're paying a mortgage on it. This factory has utility cost, insurance cost, there's depreciation on the manufacturing equipment inside of it. And none of that cost can be assigned directly to one specific desk that we've made. Instead, we need all that cost, we need all that resource to make all the desks that have been made. And so again, that's indirect cost that we will incur to manufacture our good. So product and service cost, it says, tangible products are goods produced by converting raw materials into finished products. We can look at it, we can see it, we can touch it. The desk example I just gave you. Or what if it's a service that we provide? Tasks or activities performed by for a customer, or activity performed by a customer using organization's products or facilities. So what if we were a service company, like a consulting firm or a law firm or an accounting firm? We're providing a service to our customer, but it's intangible. You can't necessarily see it. Services differ from tangible products on three important dimensions. They're intangible, you cannot see them. There's a perishability component and inseparability component to them. So just some examples here. You can see it says that we've got some product descriptions, value chain production costs, operating product costs, and traditional product costs, and the managerial objectives served for each one. So for value chain product costs, we've got R&D, production, marketing, customer service. Operating product costs, you can see it's production, marketing, customer service, and traditional, it's called production. So product cost definitions, just kind of be aware of what some of those costs are. So product costs and external financial reporting. So for external financial reporting, remember that this is when we're giving information to outside third parties, primarily investors and creditors, and we need to give them information using a prescribed format and in a prescribed way, basically generally accepted accounting principles, and then using financial statements that have a very prescribed format. And so in that situation, product cost and external financial reporting, it says costs associated with manufacturing goods or providing services are production costs. Non-production costs are costs associated with the functions of selling and administration. So basically, the cost of selling our goods, marketing, and maybe delivery. And then administration, which is kind of like a company president, the accounting department, the HR department, maybe the purchasing department, just administrative staff that is kind of overseeing on top of the production part of it. So product costs and external financial reporting, we talk about direct materials. A direct material is directly traceable to the good or service being produced. So the example I gave earlier, which is the same example in the PowerPoint, the cost of wooden furniture, right? So if I am making a desk and it's, let's say it's 90% wood, right? We can say that's for sure the direct material. There's going to be some glue, some stain, some nails, screws, some hardware, but probably a fairly small cost there. So basically you can say it's probably fairly easy to say that the wood is the direct material. Okay, direct labor, again, the people who are directly manufacturing the item. They're cutting the wood, they're staining it, they're assembling it. The overhead is basically everybody else. The production costs other than direct materials and direct labor. So I've already given you some of these definitions before. So product cost and external financial reporting, again, a prime cost then is the sum of direct material and direct labor. So the direct things are the prime costs. Conversion cost is the sum of direct labor and overhead. Okay, so prime cost, know what that means. Direct material and direct labor. Conversion cost is direct labor and overhead together. Product cost and external financial reporting. Non-production costs are divided into two categories: the marketing and administrative costs. So marketing relates to selling, the cost needed to market and distribute the product to our customers. Okay, so advertising it, storing it, freight out, maybe a sales staff salary would also be included in marketing or selling cost. Then you have administration costs. So these are product costs. or I should say they're non-production costs. I'm trying to say non-production costs. They're really treated more like expenses. Administrative costs, again, then is basically costs that cannot be assigned to marketing or production. So it could be a legal department, an R&D department, the accounting department, HR department. If we have some kind of a home office, the cost of running that home office, and so on. Marketing administrative costs are not inventoried and are called what we call a period cost. And so a period cost is just simply expensed as incurred. Whatever period we incur that cost, we recognize it as an expense. It's not a product cost. It's not a cost of making the product. It's basically a cost of having a business. And so we call that a product cost. We call that marketing administrative are just basically, they're not inventoried. They are expensed as incurred. So production and non-production costs. On the left-hand side, the column there, it says production manufacturing costs are your direct material, your direct labor, and your overhead. Everything relating directly to manufacturing my product. The non-production or operating costs is everything else, marketing and administrative expenses. And remember that a prime cost is direct material plus direct labor, and a conversion cost is direct labor plus overhead. Income statements for a manufacturing company. An income statement is given to external third parties. It's prescribed by generally accepted accounting rules. It says referred to as absorption cost income statement or full cost income statement because all manufacturing costs are assigned to the product. So GAAP says we have to use what we call it's called either way, absorption or full costing. And so every cost associated with making the product goes into the cost of making the product. And expenses are separate. Okay, so it says expenses are separated according to function and then deducted from revenues. And two major functional categories of expenses are cost of goods sold and then operating expenses. Cost of goods manufactured is the cost of manufacturing my good during that accounting period, whatever that time period we're measuring is. It says only costs assigned to goods completed that are manufacturing costs of direct materials, direct labor, and overhead. Okay. Cost of goods sold then is the cost of goods that we manufactured. They become cost of goods sold when they're sold to an outside third party. Traditional costing assumes that all costs can be classified as fixed or variable with respect to changes in unit or volume. Uses only unit-based activities, so just think of fixed cost versus variable cost. A fixed cost is basically saying no matter what we do, no matter how many units we produce, that cost will never change. A variable cost was only incurred in a direct proportion to goods manufactured. Okay, so a fixed cost would be something like insurance. If we have insurance on our factory, most likely that's going to be the same insurance cost if we make one product or a million products. A mortgage, that's another example. So it's a cost that never changes no matter what the level of output is. Traditional cost controls assign cost to organizational units. Those organizations could be a company, it could be a department. Traces cost to individuals who are responsible for the cost. So it could, by department is quite often how it's done. Now, lately, the last about 20 years or so, a better method has come along with increased technology, becomes better methods, and it's called activity-based cost and activity-based management. Basically, focusing more on activities that are incurred to manufacture something and focusing on the cost of that activity. Every time that activity happens, there's a cost associated with it. And so we're trying to assign accountability to activities, okay, rather than the cost. So an activity-based management model is focusing on processes. Basically, what are the activities that happen to manufacture my product? And we look at what they call a cost driver. This cost driver happens, there's a cost associated with it. And we're going to focus on the the process view, more along what drivers need to happen to manufacture a product, what activities are going to happen along with that, and then how will that performance turn out. So traditional versus activity-based, and we've got a whole chapter based on activity-based costing that will come up in the future. We've got another chapter that's going to focus more on traditional too. So this is kind of just big picture here, and we'll get into more of the specifics later on in other chapters. But traditional is focusing on what they call a unit-based driver. It's very allocation intensive, very narrow and rigid in terms of product costing, focus on managing cost, really is useful more in financial performance of measurement. It has to actually be used. GAAP accounting says you have to use traditional. Activity-based is more focused on just drivers, not necessarily unit-based. It's very tracing intensive as opposed to allocation intensive. It's very broad and flexible. It focuses more on managing activities versus managing cost. It's very detailed, and it uses both financial and non-financial information. Now, when we issue an income statement to the outside world, it cannot be using activity-based costing, so it's more internal only. And again, we'll get into more details about it later on. Okay, so I'm going to stop right there. As always, with every chapter, some things that you should do for the review after reading the chapter is go to the key terms at the end of the chapter, make sure you've got a pretty good handle on what that terminology is, and then quite often there will be some review questions, and you should also kind of look at those and make sure you understand the review questions. And I will post answers for review questions also. Those will get out there.